Hi, everyone. My name is Lena Castanos, and I will be moderating today's webinar along with Rashard Todd, who will answer some of the questions in this chat. I will begin by introducing myself and the Capital Pathways program. Then I will give the word to our guest speaker, Jabari Grant, and co-moderator, Rashard Todd, who will introduce themselves and take us through a presentation on what lenders look for in loan applications. Feel free to ask any questions throughout the presentation. We will be responding to them as we go. We will also leave some room for questions in the end. The questions that we cannot respond to during this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share this recording of this webinar afterwards, sometime today. As mentioned, my name is Lena Castanos, and I am today's moderator. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both a program manager and business advisor in the new Capital Pathways program. So what is the Capital Pathways program? I'm going to share my presentation now. All right. The Capital Pathways program is a specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. It offers an immersive, hands-on group experience paired with one-on-one support focused on financial and legal readiness. To be eligible for this program, you must be a very small business, have fewer than 10 employees, or be an emerging and growth-ready business that faces challenges accessing traditional financing, and you must be actively seeking capital. We start our intake process with capital readiness assessment. It's a self-guided assessment that pinpoints key gaps and support needs so that we can deliver tailored support for you. After this assessment, if you are eligible for our program, we put you in the below tracks. If you're not eligible, then you are referred to the local SBDC office for general advising or to our resource partners that can help. So our tracks include legal structure validation, financial skills and tools, and loan application readiness. So for the legal structure validation, we engage with a law firm to support with one-on-one package-based advisory sessions and discussion-style webinars with informal Q&As like this one, but for legal topics. And the topics that we cover in both the one-on-ones and the webinars include complex business registrations, intellectual property, trademarks, copyrights, contracts and agreement reviews, loan term sheets, vendor contracts, lease agreements, business acquisitions and transitions, and ownership and succession planning. Again, we connect you to a law firm that can provide these services for you at no cost. For the financial skills and tools piece, we're going to be offering financial boot camps. There is already one posted in our website for August. I encourage you to attend it, especially if you are a business that's now looking to have a more organized finances. And these boot camps include small business financial management basics for those that are trying to start organizing their finances, financial statement preparation for those who already have organized finances but want to know what each financial statement means and how to analyze them, and QuickBooks for those that are not as familiar with the software and would like to learn more about how to use it. Then we have loan application readiness, and that is focused on understanding what lenders look for, and it encompasses webinars on access to capital from a lender's perspective, mock loan, and more interactive webinars with mock loan interview stations with real-time lender feedback and group exercises analyzing sample loan applications. So the first one is this kind of webinar, just having guest speakers show us what lenders look for in your loan applications, and then the other ones are more interactive ones that we will be offering later on. And of course, we will be offering one-on-one support for any of these tracks and topics. If you are ready to get started, you can make an appointment through our website, which I am including here. And I am also including my contact information. You can also reach out to me. We will be entering this link in the chat as well, so that you can click on it and make an appointment sometime today if you'd like. That's the presentation of my Capital Pathways program. I will give it over to the guest speakers, Rashard Todd and Jabari Grant, for them to introduce themselves and take us through the presentation.
Yes.
Thank you.
Good morning. So my name is Jabari Grant, and before I get started, I'll be conducting the majority of the presentation today. Wonderful to be here with you all. I first would like for my counterpart, Rashard Todd and Brian Grant, to introduce themselves briefly. Rashard?
Good morning, everyone. I'm Rashad Todd. I'm City Nationals Bank Vice President of BCM. I do cover DC, Maryland, Virginia. And like Lena said, for one-on-one consults, if you guys want to sit down with us, I'll be one of her lenders with her for that program. Again, and my background is in commercial banking.
All right. Thank you very much, Rashard. And then Brian, can you introduce yourself, even verbally if you can?
Oh, thank you. Thank you. I was muted. Brian Grant, Vice President of Community Development and Outreach, and I work on the CRA team of City National Bank. And I'm glad to be here.
All right. Thank you so much, Brian. And my name is Jabari Grant. I am also Vice President, Business Community Manager of the Small Business Lateral Program here in Los Angeles, California. I have 27 years in business and commercial banking, along with wealth management. And we are so excited to be able to be with small business owners to help them understand and take them behind the underwriting curtain so they can get a better idea of what it takes to access capital so that you can be more educated and more focused and intentional about what you'd like to accomplish when applying for business credit for your small business. Now, inside of our seminar today, this is a table of contents of things we can expect to learn. And for due to time today, we're only going to be able to maybe do 50% of this. So today we'll go through what banks look for. So in this segment, we'll learn what a bank looks for. How do they determine your credit worthiness? What are some common pitfalls that small business owners run into when trying to acquire small working capital? And then we'll also go through when should you seek financing? So we're going to help you determine when you should seek financing, when you should go after it. And again, what are some common misconceptions and mistakes that small business owners run into when determining when to acquire capital? And then finally, we're going to go over financing purposes and types, meaning making sure that we match the right credit product with the right goal. And that's going to be so important, especially when it comes to your balance sheet. And in this, if you have any questions throughout the program, I will pause throughout this segment so that you can type your questions inside of the chat, and my counterparts will read them off to me, and we'll try to get as many questions as we can answered as possible. So we will dive right in. And the first thing we want to talk about is what do banks look for? And throughout this presentation, there'll be a common theme that we're going to always recommend, and that's going to be the importance of building your small business ecosystem. So what does that mean? Small business ecosystem means all the professionals and consultants that you need and will need to grow your business and continue to thrive and be successful. And one of the main components that should exist in your small business ecosystem, well, a few things. One should be a strong bookkeeper or CPA. It should be also a dedicated business banking relationship manager. So whatever financial institution where you choose to bank, make sure that your bank determines you worthy enough or important enough that you should be assigned a small business banking relationship manager. And if you are not assigned one, maybe because of the size of your business, we recommend that you find an institution that does provide you with a small business banking relationship manager. Also within your business ecosystem, along with the tax preparer, a bookkeeper, a business bank relationship manager, professional consultants such as Lena over at the SBDC. So these type of organizations, these small business advocacy organizations that are really fighting for you, advocating for you, and looking to educate you are all going to be important parts of your small business capital access and readiness acumen. So these are pieces that you want to put together that's going to continue to help you be successful. So what does a bank look for? Well, when you walk into a bank and you want to apply for credit, the first thing you should be easily and able to articulate is your story. A business bank relationship manager is trying to develop a relationship with you. And part of that relationship is understanding your story. They want to understand your why. What got you started? Why did you get in business? What are your goals? What do you plan to accomplish in the short term and the long term? What do you want to accomplish in the next 30 days, 6 months, 1 year, 2 years? So this way now your relationship manager and yourself are able to come together to put together a comprehensive plan about how to structure financing, whether it be debt or whether it be other depository products. But understanding clearly what your story is going to be very important to a business banker, because as a business banker, that business banker has to go and advocate for you to an underwriter. And the more a business banker understands about your business and getting to know you and understanding your passion, they become a partner with you. And so being able to tell that story gives a lot of information that the business banker can use to even help mitigate some risk that may come up in your credit profile. So even if there's a challenge in there, the business banker can use your story to help explain why that challenge may not be a challenge at all. So that's a part of the mitigation process. Within that story,
Jabari?
yes.
Sorry, I think we cannot see your slides if you
Oh,
are.
I'm sorry. Can't see my slides. I apologize. Thank you.
No worries.
Here we go. Let me know if you see that now.
Yes, perfect.
Perfect. I
Thank you.
apologize. Okay. So let me just, I'll start here. So right now we're going, what do banks look for? And here on the left side of the slide, we're talking about this story. And one, how your business got started. Again, what's your passion and what is the why? Also outlined in your story should be the management experience. You know, how long you've been in the industry, what expertise do you bring? What's going to differentiate your business from the other businesses in your segment? Also, being able to clearly articulate your operations. You should be able to explain clearly to your business banker how you get paid, how you make money, how you send and receive money, what your expenses look like, and how long it takes you to get paid, and how frequently or infrequently you pay your debts. So understanding your business operations will help your business banker to be able to clearly establish your cash flow, your spending habits, your collection methods, so that they can determine what type of financing is best, what type of terms are best, but also what type of products are best. And all these things lend to your overall efficiency. So again, it continues to highlight the importance of making sure you have a strong business banking relationship with your bank. Also, plans and objectives. You want to make sure you clearly outline your plan to your business banking relationship manager. Tell them what you plan to accomplish this year, what you want to accomplish next year, and over the next 5 years. If you anticipate a 5 to 10% growth, let them know why or how that you're going to get there, whether it be a government contract that you receive or whether it be a new primary client that you picked up. But being able to explain to your business bank relationship manager either the growth or the retraction or the reduction in your revenue, again, helps the business banker build a story for the underwriter. Also, objectives. Let your business banker know, hey, I plan to buy 2 pieces of equipment, in the next 3 months, or I plan to buy the building that we currently work in. So by letting your business banker know, that business banker can proactively help you plan and prepare along with your bookkeeper or your CPA so that you can be strategic, one, about tax savings, but also remaining bankable, finding that median in between both. But that all comes with making sure you have good relationships with your bookkeeper and your business banker, all lending to that overall theme of your business ecosystem. So understanding your plan's objectives and being able to articulate that to your business banker is going to be important in what banks look for. Competitor intelligence. You also want to have a good understanding of what your competitors are doing, what they bring to the table, and what you bring to the table that's different from them, and how that difference is going to help you acquire more market share. How are you going to be able to get the market segment or the customers that you're looking for in your region or area against your other competitors? So having some competitor intelligence, understanding what other companies in your industry are doing in your region also helps your business bank relationship manager build that story when it's time for you to go to underwriting when you're looking for capital. Now, I know what some of you may be thinking. So many small businesses bank with what we call money center banks. Money center banks are large banks. They're the top 25 banks that you're all familiar with in your region. And oftentimes when you bank at many money center banks, small businesses under, say, $5 to $10 million in revenue, it's difficult for them to be assigned a business bank relationship manager. So I say this with all the kindness and love that I can. But if your current institution, no matter where you bank, whether it be a credit union or whether it be a bank, if they do not deem your business worthy enough, no matter how small, even if you're a micro company, under $1 million in gross sales, if you can't be assigned a business bank relationship manager, find an institution who will do that for you. It's going to be an important piece in your acquisition of capital, because what tends to happen when you do not have a business bank relationship manager is you get a bank employee who will take the application but just turn in what you give them and not be very consultative about the approach, about the story, about your objectives, and actually becoming a partner with you in your business. So that's going to be an important part of your business ecosystem. The other thing banks look for, financial performance. Now, we're going to spend a lot of time here in this bubble. What do banks look for in the way of financial performance? Well, one thing is you want to make sure that the institution that you choose to bank with has an appetite for what you do. So that's one of the first things that you want to establish when sitting down with your business bank relationship manager, as you're opening your accounts, as you're determining where you want to bank. You want to make sure that if you're a roofer, that your bank has an appetite for roofing. If you're a doctor, do they have an appetite for medical practitioners? No matter what you do, whether you're a manufacturer, distributor, whether you're in government contracting, you want to make sure that your institution has a lending appetite for your industry. Now, who would be the most important person to help you determine whether that bank has an appetite for what you do? It's the business bank relationship manager. And that should be one of the first questions that you should ask when you decide to bank somewhere. Oftentimes small business owners tend to bank where they bank personally, where they have their personal accounts. And oftentimes that's with credit unions And credit unions, although wonderful for personal banking, tend not to have the acumen, the products, or the flexibility that a small business needs over time. So just because an institution will open an account for you doesn't necessarily mean that they have a lending appetite for your business industry. So when determining where you want to bank, especially when it lends to acquiring capital, one of the first things you want to ensure is, does the institution have an appetite for your industry? That's going to be very important. Now, in the way of financial performance, there is a rule of thumb that all lending institutions, but especially banks, look to that help determine your credit worthiness. This will be something you won't see on their pasted on their walls outside, or they won't even publish it. But this is a process that lenders go through in general to determine whether they want to lend to your business or not. And it's called the 5 C's of credit. The 5 C's of credit. And those 5 C's of credit are, and you can take notes, but however, I'm going to bring up another slide that's more visual for you. But just for now, the 5 C's of credit are: 1, character. Character. And we're going to go through these in depth. The second C is capacity. Capacity, your ability to repay the debt that you're going to apply for. Capacity. Third is capital. Capital. Capital meaning, what have you invested in the business? What is your skin in the game? What risk are you taking in this endeavor of your small business? 4 is collateral. And the fifth C is conditions. Now, as we go through the 5 C's of credit, there is also going to be what you see on the screen here under financial performance trends. That's going to be wrapped up in the second C, which is capacity. So I'm gonna stop sharing this slide. I'm gonna bring up another slide that's gonna help us walk through the 5 C's of credit. So give me one moment as I bring up this second slide here. Lena, if you can confirm that you can see my screen, that'd be awesome.
I can see your screen.
Perfect. Okay. So we'll start with the 5 C's of credit. Here, the 5 C's of credit, once again, character. So let's start with character. How does an underwriter who is looking at your loan application determine your character? Someone you've never met, never spoken with, and the only thing they see is your credit profile on a piece of paper. They don't know anything about your company except for what your business bank relationship manager has conveyed to them. How are they able to determine your character? Well, there's 2 primary ways that your character is determined by a bank. One is your credit report. That is the most primary means that a lender takes in determining your character. How have you handled revolving debt in the past? Have you been late? Did you declare bankruptcy and walk away from debt? Have you repaid debt? If you fell on hard times, did you repay the debt, or did the bank take a loss? What is your approach to handling debt? Are you a responsible steward with the debt that you've been awarded in the past? So a lot of that, banks use that to determine what your lending character is. Do you stick it out in tough times, or do you tend to turn around and just walk away from it? So your credit report is a way that banks use to determine what your lending character is. Another way to determine that banks determine your character now is by use of the internet. What does Google say about you? What does a quick internet search about your company and about you as a business owner say to you? Does the internet tie you to your business? Are people able to see that you are the owner of this business or connected with this business? These are the 2 primary ways that underwriters use to determine your character. Now, this really underscores and highlights the importance of maintaining a good personal credit profile. One of the common misconceptions we see, especially in the small business world, as it relates to business banking and bank lenders and bank lending. One of the common misconceptions we see are individuals selling commercial credit or making sure that your Dun & Bradstreet number is high and that banks will disregard your personal credit score. That is not sound advice. We always advise our clients, make sure that you have a good and sound personal credit profile as it lends to your overall character. As you can see, it is #1 on the list of C's because banks truly look at the character of the business, because a bad business not only puts you at reputational risk, but it also puts your lender at reputational risk. So again, making sure you have a good internet personal profile, make sure the internet is saying good things about you and your business, and also make sure your credit report shows you to be a good steward of credit that has been extended to you in the past. The other 5 C's of credit, the next important one is capacity. Capacity is your business's ability to repay debt. Your business's ability to repay debt. However, but before I get into capacity, let me pause there and see if there are any questions in the chat. I apologize. I should have done that earlier. Are there any questions currently in the chat?
Not right
So
now.
far,
We
no, it's
haven't
not.
received any in the Q&A yet, but if
Okay,
anyone
perfect.
has one, please feel free to drop them. Thanks.
Absolutely. So thank you for that. Hopefully I'm not putting everybody to sleep, but they're just so intrigued and the information is so clear they have no questions. But please do not be shy about asking questions. We love questions. Okay. So capacity. Capacity is the ability to repay debt. Now, in the personal world, we call that debt to income. You might be more familiar with that term if you've bought a house before or if you've acquired an auto loan. Debt to income meaning how much income do you have in relation to debt? In the business world, it's a different term. It's called debt service coverage ratio. And that helps a bank determine what your capacity or ability is to repay the debt that you're requesting. So what is one of the ways or the primary way that a bank determines your capacity? Well, one is by your business financial statements. That's primarily by means of your profit and loss statement and your balance sheet. Now, this should highlight the importance of that part of the business ecosystem we spoke about earlier, your bookkeeping or your CPA or tax preparer or anyone in your business or that you have as a consultant that helps you maintain sound financial records. It is so important. One of the common pitfalls we see among small businesses is their inability to produce regular financial statements, a profit and loss statement, a balance sheet, and when applicable, an AR aging and an AP aging report. That's an accounts receivable aging report and accounts payable aging report. What an AR aging report is, it shows all of your receivables. That's everyone who owes you money. That's work that you've done that you haven't been paid for yet, that you have out, that you've invoiced out and you're waiting to be paid. That's an accounts receivable. An aging report shows how long it's taking you to get paid, whether your clients are paying you in 30 days, 60 days, or 90 days. That's what an AR aging report is. An accounts payable aging report is money that you owe, bills that you need to pay, and it shows how and what frequency you pay your bills, whether you pay them in 30 days, 60 days, or 90 days. So typically what banks look for when they look at your accounts receivable, they're looking for your clients to pay you or your ability to collect what you're owed within 90 days or less. That's the most that's the best, I should say, scenario that bankers are looking for. But these are the financial statements that banks use to determine your capacity. Again, it's your balance sheet, it's your profit and loss statement, and where applicable, it's your AR and AP aging reports. So let's take a look at a mock profit and loss statement. We're going to look at one profit and loss statement, and we're going to look at one balance sheet. And the purpose of this one is just to help you determine how banks look at profit and loss and balance sheets, but also why it benefits you to keep sound financial records as a small business. So in your profit and loss statement, as you'll notice here, it should determine your revenue, your expenses, and your net profit. So in this is a mock profit and loss statement that shows Q1, the first 3 months of the year, and Q2. So you'll see here when reviewing this profit and loss statement, we see that the revenues were roughly $55,000 for the first quarter. So in the first 3 months of the year, they made revenues of $55,000. These were the expenses. This is their payroll. This is their rents and utilities, their supplies, and this is their total expenses. So on all that, their profit was $13,000, completely profitable. And this is good news, right? And remember, we're also focusing on financial trends as a bank. But look what happened in Q2. Same revenue sources, fee income, child care program reimbursement. They have the same total revenue. But you notice that their profit was 38% less than Q1. So what can a business owner now do, seeing that they made the same amount of money, but they profited less money? Well, the key is to go through the expenses. What changed? The wages were the same, supplies were the same, but look what happened in rent and utilities. They doubled. In this case, what happened? The utilities doubled because there was a water pipe that had broken under the building that had increased their water bill by almost double. The business owner had no idea. Now, if the small business owner would not have had quarterly financial records to review their trends, this could have gone on for a whole year. What would have happened at the end of 12 months with the utilities doubling and tripling, along with whatever damage that would have happened to the building that they were in? It could have put them out of business. So this underscores again the importance of having regular, sound financial records, not just for lending, but so that you are able to determine as a business owner what products and services are working. What products or services are we making a profit on? What product and services are we breaking even or even losing money on? You can only determine that and then make adjustments if you have good financial record keeping. When a bank or a business banking relationship manager sees that you keep good, sound financial records, it gives the bank confidence that you have, one, the business acumen and the responsibility of making sure that your business continues to run soundly. And you'd be able to articulate trends. Why did we increase in revenue? Why did we decrease in revenue? So again, a good profit and loss statement is good information for yourself, but it also shows a lender what your trends are. So if you know that your revenue is trending up or your profit is trending down, now you can see, well, why? You can articulate that to the business bank relationship manager. And now that business bank relationship manager can create a story to the underwriters to help overcome that challenge. If you're increasing in revenue and net profit, great news, but why? So that way now your business bank relationship manager can build a story of how that growth is sustainable and why we need to lend money to you to help finance that growth and facilitate it. But keeping good, sound financial records are going to be an important aspect of you being able to acquire the working capital you need. The other part of good financial records would be the balance sheet. Now, the balance sheet consists of assets, liabilities, owner equities, and overall, it shows the value of the business. So here is a mock list.
Jabari,
Yes,
before we go, we have a
yes.
question in the
Oh,
chat.
perfect. Thank you.
Yeah,
Absolutely.
so I'll cut you off. Joey asked, would banks place more weight on the historical performance or the projected cash flow?
Great question. So when it comes to using either projections or historical cash flow, it's going to depend on the lender and the credit being requested. There are programs such as the SBA, the 7A loan, that will absolutely use projections for future considerations for either buying a building or even working capital. And at the same time, there are some lenders who solely look at current cash flow and historical cash flow. So it really depends on the bank's appetite and what they and how they underwrite commercial credit. So the question becomes this: who is the best person to determine whether the institution you bank at or at applying with will determine whether that bank has an appetite for using projections or historical cash flow? It's going to be your business bank relationship manager. So these are educated questions that now you as a business owner can ask your current institution. Do you guys lend on projections? Will, if I get a government contract, will you lend based on the contract that I'm going to receive moving forward? Or are you simply looking at what happened over the last year? These are good questions that you want to ask your lender when applying for credit. And also, working with Lena at the SBDC as well. They work with a ton of lenders, And they'll also be able to help guide you to the right lender that you need for your specific needs. So that's a great question. So the answer once again is it depends on the lender's credit appetite, their underwriting appetite. Any other questions? No? Okay, great. I hope that answered that question well, but great question. Please continue to ask.
Jabari, we have one more question
Yes.
from Miss Brown. What if your business isn't making any money at all, but you need funds to create a digital marketing campaign to gain more clients?
So for a company that's not producing revenue currently, right? Typically that business will be treated as a startup business in the banking world. Typically banks do not lend to startup companies. So if you have a company that's not producing revenue, usually there are three options. One, you can go with a CDFI. A CDFI is, and Brian, correct me if I'm wrong, I'll always get this acronym botched up, but I believe it's a community development financial institution. And these are nonprofit lenders that help small businesses get off the ground. Some of them have an appetite for startups, some of them do not. Again, this would be a good situation to consult with Lena about when you have your one-on-one consultation. Also, you can consider VC, which is venture capital, or private equity. These are investors that invest in new companies or startup companies. And however, you will have to determine whether you're willing to give up equity in your company for that investment, or if they're willing to give it to you as debt. But when it comes to businesses who are not producing any revenue, it will limit your access to capital, because typically lenders want to see you in business and generating revenue so that they can determine your capacity or your ability to repay. If they're unable to do that, you may be looking more for investors rather than lenders. Hopefully I answered that question well. All right, any other questions? Okay. Now back to the capacity portion and the sound financial statements, and the other part of the financial statement that corresponds with the profit and loss sheet is the balance sheet. And the balance sheet, as it states here, is the state of your business on any given date. So the three components to a balance sheet are this. It's the asset section that you see here. Assets are typically your bank account, your accounts receivable is an asset, and any either leasehold improvements, buildings, or equipment that you own will be in your asset section. Liabilities. There's current liabilities and long-term liabilities. Current liabilities are current liabilities are liabilities that are going to be repaid within 1 year or less. Within 1 year or less. Any debt that is going to take greater than 1 year is a long-term liability. So often you'll see the liability section broken down by long-term liabilities and current liabilities. Now, the difference between your assets and your liabilities is going to be the amount of equity that you have in the business. So that's going to be the overall value of the business that you've built up. And when you see retained earnings, this is the net income that you've retained in the company, the net income from the business from the previous year or previous period that you're going to keep in the business. Now, why does a bank look at a balance sheet? Why is this important? Well, one, a bank is able to determine if you're what is called over leveraged. Over leveraged means that you have more debt than you do assets. And although it's a small business, that may be typical. So banks and lenders won't put a lot of credence in that. However, it still is a good indication of what direction you're going in, and it will help them determine what type of debt you would need to help you avoid being over leveraged in the future. So at the small business size, and that's $10 million or greater, lenders won't put a lot of credence in that. However, it is a good indication for them to understand better what type of debt would be best for the purpose that you want to use it for. So balance sheets and profit and loss statements are going to be two things that help determine your capacity or ability to repay debt. Now, what does a bank use? What is that calculation that banks use to determine your capacity? And it's the debt service coverage ratio. It's the debt service coverage ratio. In terms, it's also called DSCR, debt service coverage ratio. So it shows how much money that you're making that will help you service the debt that you're applying for. It's calculated by taking your operating income. Operating income is your revenue minus your expenses, and then dividing it by your total debt annualized. And we're going to take you through an example of this so you can see it. And so a business DCR is, once again, the net operating income plus non-cash expenses. Non-cash expenses. Let me explain what that is. So oftentimes, you have a great bookkeeper who understands what they're doing and is trying to help you save money in taxes, but at the same time help you bankable. They will use the current tax laws and use some of your equipment or whatever they can as write-offs by using non-cash expenses such as depreciation. Depreciation would be maybe a piece of equipment that you acquired in 1 year, and by law, they're allowed to depreciate it. So depreciation may be an expense on your profit and loss statement, but because it was a non-cash expense, just because your company vehicle went from $40,000 in value to $20,000 in value, that's $20,000 of depreciation. However, $20,000 didn't actually leave your business bank account. So that's what you call a non-cash expense. We can use that dollar amount to add back to your income, being that it wasn't real money that left the account. So that is a non-cash expense, an expense where there was actually no cash that left the business. So we take your net operating income, we add back any non-cash expenses like depreciation, amortization, and then any interest you paid on current debt. We add back the interest because it's already going to be considered in your total annual debt payments. So by adding all these back, divided by all your annual debt payments will give you your debt service coverage ratio. So an example of that, let's say you had net income of $100,000, okay? And you had a total debt service of $60,000. I apologize, I'm missing a zero there. If you were to divide the 100,000 by the 60,000, so this is your net income divided by all your debt. So let's say you have a debt of $5,000 a month. Let's say you have an SBA loan. That SBA loan is $5,000 a month. Well, then that's $60,000 for the year. So your net income was $100,000 for the year. Your debt payments are $60,000 for the year. Your debt service coverage ratio would be 1.67. 1.67. So what does that mean? That means for every dollar that you're borrowing, your business is making $1.67. Okay? I'll repeat that again. This ratio means for every dollar that you're borrowing, your business is producing $1.67. So what ratio or number is a bank looking for? On average, banks usually look for a debt service coverage ratio of 1.25 or greater. 1.25 or greater. When working with government guaranteed loans, which have a little lighter underwriting standards, they require a 1.15 debt service coverage ratio. But for the most part, banks are looking for 1.25 or greater. So 1.67 would be a very good cash flow. This would be a cash flow that demonstrates that this business has the capacity to repay their debt. Here's another example of a mock profit and loss statement. And so I use this so that I can, again, show the benefit of using non-cash expenses when determining your capacity. Okay, so again, this business made $1 million. Their cost of goods sold was $6, so their gross profit is $400,000. Now here comes the expenses, right? These are all the expenses, so that after their expenses, their total expenses are $233,000. That means their operating income, their income from operations, is $177,000. They have some additional non-operating income, which is okay. We'll use that too. So overall, their net income comes out to $178,400. Now, we're going to assume that this same company has a $5,000 monthly payment on a debt, right? So let's determine what our debt service coverage ratio would be. I'm going to bring over my calculator. Let me know if you all can see it. Okay. Let me make it a little
We can
smaller.
see it.
Okay, perfect.
And we have 10 minutes more.
Okay. All right. I'll go through this part really briefly.
Thank you.
So no worries. So if you have 178,400 for your net income, right? Plus, we're going to add back non-cash expenses like depreciation. So that's $80,000 we get to add back. That's good news, right? And now if we were to divide that by our annual debt, $60,000, our debt service coverage ratio is 4.3. That's extremely strong. So that's rare to have one that strong, but I just wanted to give you an example of the formula. So overall, I'll stop sharing my screen now. When determining your capacity, or the 5 C's of credit, this is what banks use to determine your capacity. And I'll share my screen again. And thank you. So the story and the financial performance, these are two things that are going to be extremely important to a bank, which again is talks about the importance of a business bank relationship manager and a good bookkeeper. So when should you seek financing? Well, be proactive about seeking financing. One of the common misconceptions and pitfalls we see with small business owners is they have the misconception that debt is bad. Avoid debt. Well, debt is not bad. Most of the larger companies you see never use their own capital, but they always leverage or use capital from the bank to grow their business while they invest their company funds inside the business. So when should you seek financing? Seek financing when your business is doing its best. Just because you're doing well today, do not think that it is important to acquire a working capital line of credit or some sort of facility that you can have in case the industry makes a sharp change, when there's a change in external conditions that you can't control. One of the examples we saw is maybe earlier this year, when all of a sudden the industry wasn't sure what was going to happen due to tariffs. There was a lot of uncertainty in the market. So manufacturers that ship and import items from overseas panicked. And what happens when that happens also is banks are also looking at this saying, man, we need to adjust our underwriting standards because this could be a risk for us. So for banks that maybe didn't get that financing when things were great, are now a little bit uncertain about what the next 6 months to a year may look like. But a business who is proactive about acquiring a capital has a working capital line of credit already there in case there's a sudden change in the market, so they have additional liquidity that they can tap into to help them weather the storm. So again, the most optimal time to seek financing is when the business is doing well. Now, who is able to help you determine what type of financing you should seek when things are well in case there's an emergency? It's your business bank relationship manager. Again, this is going to be an important consultant for you as you navigate this space and your business is growing. So avoid waiting to obtain financing when there is an immediate need. One, it causes a lot of anxiety, it causes a lot of stress, and there's a lot of uncertainty. Because oftentimes when a business desperately needs financing, it's typically because there's a downturn in the financials. And if there's a downturn in the financials, well, now your underwriter and your business bank relationship manager has a more difficult hill to climb in order to get that working capital you need. So again, the best time to get financing is when your business is doing well. Don't wait. Do it now. Financing purposes and types, and this is where this will be the last part of our segment here. There's short-term financing and long-term financing. It is important that you make sure you match the right purposes with the right types. You want short-term financing for short-term uses. So we talked about current liabilities and long-term liabilities on the balance sheet earlier. Current liabilities being liabilities that are going to be repaid in 12 months or less. So you want to use short-term financing for liabilities that are going to be paid in 12 months or less. Things like payroll, monthly costs. Or an example is, let's say for an example, you manufacture t-shirts. So you have to put out money to buy the materials. You have to put out money to get them printed and to get them shipped to your clients. And then you put that on your accounts receivable because you're waiting to be repaid. Well, a short-term financing example might be a working capital line of credit. Rather than you using your own dollars, you advance from your working capital line of credit, you buy the raw materials, you put them together, you manufacture them, and you ship them out. And while you're waiting 30, 60, or 90 days, you're able to make interest-only payments to this working capital line. And then when you receive your revenue, you replenish the line of credit and only to do it again. So that working capital line, that is a short-term working capital line of credit. So let's say, for example, you need a piece of equipment. Let's say you need to buy an automobile. That automobile has a life of, let's call it 5 to 7 years. If you're not going to pay that auto loan off within 12 months, then you would never want to use a short-term credit product for a long-term purpose. What could happen? Well, this is what happens. We see it often in the small business world where the line of credit is used for everything and it shouldn't be. So if you were to use a line of credit for an auto loan, well, what is the danger? The danger is this. Now that debt, let's call it $40,000, sits on the liability section of your balance sheet. And because you're likely making interest payments only, or even if the principal payments you are making aren't enough to pay that loan off in over 1 year or 5 years, what happens is as that asset begins to depreciate, the liability stays there. It doesn't depreciate or amortize, I should say, at the same rate that the asset is depreciating. So when you use a long-term credit facility, such as a term loan is a fixed rate loan with a fixed term. That means you get 5 years to pay it off. You get fixed payments so that at the end of 5 years, that loan is paid off. That is a term loan. That is an example of long-term financing. Why would that be more appropriate for our example? Well, you have that loan for the automobile. That automobile is depreciating, but at the same time, that loan is amortizing so that they're both decreasing at the same time. So when it's time to buy a new truck, that debt is off of your balance sheet and the asset is fully depreciated. So if we were to use a short-term product in that same scenario, that asset would depreciate, but a portion of that debt would still be on the balance sheet. And that means now you're over leveraged because the asset is gone, but the debt is still there. So making sure that you use the right credit product type for the right purpose is going to be important, and make sure in ensuring that you build a sound balance sheet moving forward. So that's the importance. And again, who is going to be the most important person to help you determine the right credit product for the right purpose? It's going to be your business bank relationship manager. Again, we can't and highlight enough how important it is to make sure you continue to build that strong small business ecosystem of good consultants that will advocate for you and help you in the capital acquisition process. So I'll stop right there and see if there are any questions that we have.
Yeah, we got a few questions. Excuse
Okay.
me. First question is, do banks only lend in certain industries?
So again, that's going to depend on the bank. So all banks and different banks all have different appetites. Some banks love contractors. Some banks won't bank contractors. Some banks will bank the entertainment industry. Some banks will not touch the entertainment industry. So every single bank has a different appetite. And so it's just important that when you in deciding what institution you want to bank with, that you make sure that that institution has an appetite for your industry. But there are some overarching industries that banks won't touch. For example, cannabis is one of them. Anything having to do with the adult industry, the adult entertainment industry is another one. And oftentimes, financial institutions, check cashing companies and the like, where they're heavy cash intense. Those are three that I can think of off the top of my head that banks will stay away from primarily.
Thank you. Next question is the DSCR standard of 1.25 times the same for agricultural lending?
No. So agricultural lending, depending on the size and scope of the ag lending, it's a totally different underwriting process and a totally different appetite. So if you have an agricultural company that's greater than $40 million, say per se in annual gross sales, typically they'll use what's called ABL lending or asset-based lending, which means that they underwrite to the balance sheet rather than the profit and loss statement. And rather than looking at historical cash flow, they'll look at assets. But again, it depends on the type of ag, the type of business, and the credit request. So no, agriculture in itself is a totally different underwriting standard. But great question. We can talk more about that offline on a one-on-one basis. And of course, again, Lena will take those and will parse those out as appropriate. But great question.
Well, I would like to thank Jabari, Rashard, and Brian for coming and being our guest speakers for today and co-moderators. And I would like to thank everyone that has attended. Again, there will be more webinars like this one in the future, and we will also have some financial basics webinars, some financial statement boot camps that offer a deep dive into financial statements. And again, if you need support now, feel free to go to our website, book a one-on-one session, and we will ensure that you get the help you need. All right. Well, thank you, everyone. Have a great rest of your days.
Take care.
Goodbye.
Take care.